Welcome everyone to Capital Management Corporation's July 2023 webinar. We appreciate you joining us today. We had quite a few registrants and looks like we're going to have a near record attendee list today. So we appreciate you joining us and look forward to sharing our thoughts in the next 30 to 40 minutes. My name is Scott Dowell. I'm Vice President of Marketing, Client Relations, and Business Development. And our presenters today and who are with me are Tim Call, who is President and Chief Investment Officer here at Capital Management Corporation, and Mark Livesay, who is Vice President and Portfolio Manager. And before I jump into the agenda, I have two housekeeping items that I just wanted to mention. First is we will take questions at the end of the webinar. You will see on your screen probably to the right of you a list of actions that you can take. One of them says questions. You just click on the caret. You'll get a drop-down menu. You can put your mouse within the question box, type it in, and send it to us, and we'll get to that at the end. The second housekeeping item is we are recording this, as we do with all of our webinars. We will post it up on the website either tomorrow or Monday. If you weren't able to stay with us until the end, you can go back and click on our website to see the rest of it and/or see it again. But we will send an email out to everyone to let them know that when that webinar is up. And again, that will be either posted tomorrow or Monday. With that said, I'm going to go ahead and remind everyone of our agenda today. It was in your email invitation. We are, as we do with previous webinars, we're going to discuss and give our thoughts on the current economic environment and what the outlook may look like moving forward into the second half of the year as well as into 2024. How is that affecting the market? And what is our firm's viewpoint on both stocks and bonds to date, as well as in the near and long-term future? And lastly, today we're going to discuss diversification and how to achieve it. Obviously, we have a very heavily weighted, narrow equity market right now, and Tim's going to address that and share his thoughts on it. So with that said, I'm going to go ahead and pass it over to Mark.
Thank you, Scott. Appreciate the intro. Generally speaking, the U.S. economy remains stronger than many would have predicted at the beginning of the year, with the long-awaited economic recession yet to materialize. The U.S. consumer, which represents roughly 2/3 of the economy, has remained resilient. We think the root of this resilience has been the labor market, which has remained very healthy. This chart here represents job openings. Demand for jobs was nearly 10,000 in the most recent data in May. This is down from the 12,000 peak in March of last year, but does remain well elevated versus long-term history. Another sign of strength in the labor market is the most recent unemployment rate of 3.6%, which is below historic norms. And anecdotally, we're seeing labor unions become a little more aggressive. The United Airlines pilots won large pay increases. In Hollywood, both the writers and the actors are on strike, which has garnered media attention. The Teamsters and UPS are set to begin negotiations near the end of the month. So it would be unusual to see this sort of aggressive labor union and labor action in a weak labor market. So we think that those actions are indicative of a strong labor market. And it would be very surprising to see a recession while having a very strong labor market. So this is certainly something that we're going to keep our eyes on, and we think the labor market is very important. Just reiterating that the U.S. consumer is 2/3 roughly of the economy, and when the consumer has a job, they tend to spend money, and when the consumer is spending money, we tend not to see very weak economic results. So the other major factor facing the market over the last 2 years really has been inflation. The most recent data is reflected in this chart. Inflation has been elevated for roughly 2 years now, but we are making progress. After peaking in June of last year, June of 2022, at 9.1%, the most recent June 23 reading was 3% in total. So prices were up 3% year over year, with the core level rising 4.8%. That 3% increase was the lowest level of CPI reported since March of 2021, so 2 years plus. We've broken out the different components before, and we just like to show these, but I won't belabor the point. The shelter component, which is roughly 30% of the total CPI and would be even a higher percentage of the core CPI once you exclude food and energy, does remain elevated at 7.8%. After pausing to keep the overnight rate flat in their last meeting in June, the Fed is expected to increase the overnight rate by another 25 basis points during next week's meeting. I believe they meet Thursday and Friday of next week. Increases beyond that will likely depend on inflation and employment trends over the next few months. It would not be surprising to see more pauses like the pause we saw in June. However, we would not predict that the Fed would decrease interest rates in the near future. There are some market participants that were certainly predicting that just a few months ago, that we'd see decreases, and we do not see that and have not seen that or predicted that in the near-term future. The shelter component does work on a lag, and with that core CPI level at 4.8%, we're not really that close to the 2% level that the Fed would like to see before they'd even think about decreasing rates. This next chart goes longer term and looks at the 10-year Treasury in the blue line, in the 10-year Treasury minus core inflation in the gray line. So a couple of things to note here. Despite the recent increase in the 10-year Treasury yield, that yield does remain relatively low compared to history, particularly history before the financial crisis. And also the real yield is negative, which is not all that common. It's unusual going back to the 1950s. Simply put, this means that interest earned on the 10-year Treasury bond is not enough to cover current core inflation. So if you have a 10-year Treasury bond, you are making less than the core inflation number. We do believe that the 10-year Treasury yields should rise, given the Fed's challenges in getting the core inflation level to 2%. And that potential for higher long-term rates pressures long-term bond returns, as everyone knows, as rates rise in bonds, prices fall. For this reason, we would keep bond portfolio durations, if you do have a bond portfolio, very short. Another reason for a short duration is shown on the next chart, which is the yield curve. On this chart, we want to focus on the current yield curve, or the June 30th yield curve, which is the blue line, which is the highest line on the page for most of it. The important thing to note here is the yield curve is currently inverted, meaning that the yields available on shorter duration bonds are higher than the yields on longer duration bonds. So in a typical environment, you take more, you lock in your return for a longer period, and for locking your money in, you get a higher rate of return, a higher income, a higher yield. This is the opposite of that, where the shorter you go, the more yield you get. So given that we can make more interest on shorter duration bonds at the moment, we would keep bond investors to portfolios very short in duration, so that we get our principal full back quickly, and we could redeploy into either higher yielding bonds or perhaps equities. We do believe that over time, longer dated bond yields will have to increase as investors will demand positive real yields, so yields higher than inflation, which is not the circumstance that we have now. And now I'm going to shift from a quick inflation and bond viewpoint to the most recent equity trends. and this is a cover of Forbes magazine. And over the last few months, the artificial intelligence, or AI, has captured the imagination of the market and the financial press. Many stocks with publicized AI businesses have seen outsized growth in market cap. It's been a tremendous move. This Forbes magazine cover, is obvious. Artificial intelligence gets real. And although it's very hard to see on the cover, the slide of this issue of the magazine was published in November of 1998. So artificial intelligence isn't exactly new. I think for many of us, our first thought into artificial intelligence was maybe the 1984 movie, The Terminator, when Arnold Schwarzenegger comes back and tries to kill the leader of the resistance because the robots have taken over and turned on humanity. So the idea of AI isn't exactly brand new. The stock depicted in this article from 1998 is PCorder.com. That stock IPO'd at $21 per share in February of 1999. That same day, the stock traded to $47.15. So very, very strong first day of trading. However, by October of the next year, the stock had fallen to $3.44. That month in October, the stock was purchased for 6 3/8. So if you were involved in the IPO and you held until the stock was taken over, you lost nearly 70% of your investment. And if you were unfortunate enough to not be in the IPO and had bought that first day and then sold before the company was purchased, you could have lost as much as 93% of your investment. So best case scenario, I guess you got in on the IPO and sold day one, but if you held long term, you certainly weren't going to do well in that investment. And we just want to point out this cautionary tale. So-called new ideas and technologies that carry a lot of hype do not always turn out to be the best long-term investments. And AI may very well be valuable in the long term, but the value of the product is unlikely to just be limited to the technology companies that are producing the AI, but other industries that are implementing the AI to gain efficiency and other advantages in their businesses. So just wanted to point that out. And now I will turn it to Tim, who's going to discuss some of the concentration and diversification issues in the market today.
Thank you, Mark. Some market pundits forecast a faster end to inflation, declining interest rates, and a Goldilocks economy. Technology stocks have already rebounded from the pummeling they incurred in last year's bear market. AI's return to the front pages of magazines is a new craze for many. It has lifted technology stocks to ever loftier levels. Investors are acting desperate for exposure to future technology growth. Yet AI is not a new story. And many rather traditional companies have been utilizing and benefiting from AI applications for years, some even decades. For example, logistics firms use AI to adjust delivery methods in real time. AI is used for drug discovery, mining of commodities, financial decisions. A diversified portfolio can have plenty of AI exposure from the users. As investors have flocked to some of these technology stocks, though, many of them have become too expensive. One can buy many Jenga sets and build a rather high tower, but we know the bigger the set, the bigger the subsequent corrections can be. Just 8 of the 30 largest U.S. stocks represent 29% of the S&P 500. When an investor puts $100 into that index, almost $30 goes into just these 8 stocks, which have an average PE of about 31. Of these magnificent 8, we think Alphabet, the parent company of Google, is the most attractive, with an estimated forward PE valuation multiple of 21. Tesla, Amazon, and NVIDIA have forecast forward PEs of 66, 62, and 48 respectively. They're quite expensive and ripe for a larger Icarus landing. With excessive mega cap technology exposure, this 500 stock index does not currently appear diversified. Because the S&P 500 is market cap weighted, more expensive stocks represent a larger portion of the index. Typically, large cap stocks trade at lower valuation multiples than small and mid cap indices. This is currently reversed. In aggregate, large cap dividend yields tend to exceed the yields of small and mid cap stocks. This historical trend is also currently reversed, likely due to some large and mega cap valuations moving to lofty levels. Overvalued stocks represent a large portion of the S&P 500 index. As their valuation multiples contract toward more normal levels, that index's returns should be subpar. When one index is just too expensive and not very diversified, investors should focus on undervalued, growing, profitable, cash-generating opportunities. We strongly believe in this diversification. We have meaningful exposure to many attractive sub-industries. We seek out growing cash cows that are leaders of profitable niche industries with bright prospects. Owning a portfolio of many niche leaders almost guarantees vast diversification. For how many leaders can a niche space have? It is rare that we hold 2 or 3 stocks within the same sub-industry. Such positioning would suggest an extreme opportunity. Our approved holdings list tends to be spread across most, if not all, economic sectors. With our focus on cash cows, our portfolios frequently sport dividend yields of 2.5%, 3%, or even over 4% for dividend-focused strategies. Unlike the S&P 500, we can own $10 billion mid caps, $2 billion small caps, and even $100 million micro caps. Moreover, we do not have to be overweight in overvalued stocks. We can be overweight and undervalued cash generators with strong growth prospects. This page reflects opportunities in an array of attractive sub-industries. Last winter, our webinar referenced a 5G patent holding firm that was overlooked by the large cap managers. Today, its 6.5-month stock price return is 96%, which excludes the quarterly dividend. It had strong characteristics that we seek. Recurring revenue was growing. Incremental revenue was earning very high profit margins. In turn, this was going to lift already strong company-wide profit margins. Exceptional cash generation resulted in balance sheet cash levels exceeding debt levels. Interest income was about to exceed all of the firm's interest expense. And finally, the firm resumed share repurchases, which were accretive to earnings per share. We did not know what day, month, or year this 5G patent holding stock would move. But when the markets wake up, individual stocks can move fast. One should build investment positions while others are asleep at the wheel. We did just that. We had built our full position before the stock moved. 96% is a pretty good stock price move in just 6.5 months. So far this year, 2 other major holdings agreed to sell out for cash. One of these stocks doubled the next day. These firms had been undervalued. Moreover, they were huge cash generators with prospects for above average long-term growth. We did not know when the market would pay attention to them, but we had built our positions. We were ready. We are invested in many attractive sub-industries overlooked by the large cap investors. Today, we would like to focus on 3 local TV broadcasters. The market has been treating these stocks as if they were the Rodney Dangerfields of Geico cavemen. Meanwhile, these firms have been adopting digital technology to broaden their product offerings, depth, and width. With the right implementation, one traditional local channel can now broadcast multiple digital channels. In turn, these digital channels can be added to many streaming services. The leaders of this niche are experts in accumulating and broadcasting local news. National cable and streaming firms are realizing that their viewers want and need local news. Increased competition between streaming services serves to just further increase their desire to lock in these news offerings from the largest and best local news providers. Now, with multiple digital channels, the dominant local TV providers are also moving into regional sports. New free digital channels will start generating revenues that can be shared with the sports teams. Of course, the local digital channel owner might keep the largest share of profits for themselves. With greater distribution revenue and more digital channels and a larger advertising audience, these firms' revenue should grow. On top of that, we expect record election advertising next year, given the presidential election as well as statewide and local elections. We might not like seeing all of those advertisements, but ad time slots will be sold out and ad prices will be higher. For these firms, there are only a few costs that will rise as revenue grows and reaches new records. Because of that, gross margin will grow faster than revenue, and operating income will grow faster than gross margin. We expect net income to grow even faster than that. Record revenue and profits will add to these firms massive cash generation. This excess cash is being used to retire debt and repurchase shares. The lower debt levels raise the firm's value and quality profile. Declining debt also lowers interest expense, raising net income. With fewer shares outstanding, earnings per share can grow faster than net income. As investors are attracted to the rising growth and quality profile, demand for these shares of stock should increase. Meanwhile, the supply of shares has already decreased. The Big Eight, the Magnificent Eight cited on our earlier page, might face multiple compression while these local TV media firms get recognized and receive a higher valuation multiple. On average, these media firms are trading at less than 3 times on a price to free cash flow basis. Over a good part of the last decade, two of them have tended to trade closer to a price to free cash flow of 6 to 10. The third one, 8 to 15. Can these stocks double or triple in price over the next 1, 3, or 5 years? Well, there's a reason why we own all three of these local leaders. Our positions have been built. As we patiently wait, these firms are sharing part of their cash generation with investors, not a 0.1% dividend yield. Their average dividend yield is 4.5%. When our 5G firm nearly doubled year to date, the large cap index investors received none of the benefit. That overlooked stock was not in the index. When another holding doubled overnight on its cash takeover announcement, again, the large cap index funds made nothing, while many of our clients reaped large rewards that day. The average equity market capitalization for our three local broadcast leaders is only $2.6 billion. They are not components of the large cap indices. If these stocks double or triple, those index investors will not benefit. On the other hand, our average stock investing client will certainly feel it. The average stock market capitalization for a Magnificent 8 stock is $1.4 trillion, roughly 500 times the size of these local broadcasters. As momentum changes, it takes only a tiny fraction of money to come out of these 8 stocks and move into small cap stocks and mid cap stocks like our local broadcasters, to move them a great deal. Our 3 broadcast firms have already been buying back their shares and or paying down their debt. With fewer shares outstanding, increased buying of their stock should result in higher stock prices. The moves can be big and fast. Their record revenue in 2024 is getting closer every day. We do not know what day, month, or even year these companies will be rewarded, but we know these growing cash cows have been greatly overlooked for too long. Eventually, their excess supply of stock will have been absorbed. Quants or computer traders will have their computers telling them that these companies are growing fast and trading at low valuations. Eventually, price momentum traders will see the positive stock price trend, and positive company fundamentals and stock momentum screens will light up for other investors. A lot of money can move into these undervalued stocks. But weak, impatient holders have already sold their shares back to these companies or to us. For we have already built our full positions. We're allowed these growing cash cow dividend payers are already in our growth stock portfolios, our dividend appreciation, focus, growth and income, and SMID portfolios. So we are ready, and we are being patient, but 2024's record revenues for these firms are getting closer every day, so I don't think we have to be patient for much longer. When these stocks move, the large cap index investors will not make a penny, but most of our stock investing clients will be ecstatic. A few might even complain about making so much money that they have to pay taxes. This is a good problem. We are invested in many attractive sub-industries. Our approved list contains stocks trading at low valuations with growing cash generation. These include large, mid, and small caps and dividend growers. We find this diversified mix of stocks to be more attractive than overvalued tech-heavy indices. Our adherence to time-proven disciplines has benefited our clients over time. Patience is key when the herd moves with thematic stories to ridiculous heights. But already our patience is being rewarded this year. And small cap, mid cap, dividend grower, and value disciplines can have exceptional long runs of 3, 5, and even 10 years. We know our companies, their long-term fundamentals and outlooks. Our size enables us to be dynamic. We can rapidly deploy proceeds from cash buyouts. We have built our positions. We are ready and excited. Thank you for letting us share our thoughts on some of our niche industry leaders. Back to Scott.
Thanks, Tim. Thanks, Mark. We are going to move into Q&A here, and I've got a couple questions already. First question is, after strong results in my account for the first half of the year, what do you expect for the second half of the year? I guess, Tim, that's probably a good question for you to answer.
Well, just like with any individual stock, it's hard to predict short-term moves in the market. You can have a surprising news flow or changing sentiment on a very short-term basis. There's a lot of volatility. That's the price you pay for being invested in stocks. The benefit is, over the last 100 years, the annualized return for stocks has been just over 10% for large caps and over 11% annualized over the last 100 years for small and mid caps. So we see those long-term trends continuing, but we also see volatility continuing. We strongly believe that our style will be rewarded much more than the general indices over the next 1, 3, and 5 years. So while we cannot guarantee any returns over the next 6 months, we think several of our companies will benefit both from rising sales, rising earnings, and rising investor interest. So we are optimistic that we'll continue to receive positive benefits. The exact timing, though, is uncertain.
Okay, thanks. Another question, Mark, this is probably more for you. Have we seen the end of the banking industry challenges?
Thanks, Scott. I guess that depends on what challenges you're talking about. I think as of now, it is we're not seeing any more bank runs. So that period in mid-March into mid-April, bank runs were a big problem, and companies were losing deposits hand over fist, and liquidity became an issue. That kind of feeds on itself and can become, and for a couple different companies that we talked about last time, did become a big issue. It does not seem like that has continued. The Fed's actions to allow companies to borrow based on the book value of their bonds and shore up liquidity helped that. However, even without bank runs, there are challenges. The primary challenges that I think will come up is going to be increased funding costs. So the cost of deposits for these particularly smaller regional banks will be high, so that could pressure their net interest margins. And then we're also going to have potential losses in the credit portfolios. So whether or not you have a normalization in consumer credit and the credit card areas, or maybe even more potential worrying, the commercial real estate portfolios. So office space today is thought of a lot different than it was 3 or 4 years ago. And a lot of companies have longer term leases, and as those come up and people don't renew, these buildings don't produce as much cash flow. So we'd want to pay very close attention to the commercial real estate portfolio in a given bank. And overall, we're not feeling positive about the smaller and regional banks due to the increased funding and exposure to real estate. But some of the larger companies that are more consumer focused or bank-to-bank focused or transaction focused, we do feel very good about. So,
okay, we have another question. Don't know which one of you want to take this one, but I'll let you fight for it. Is it possible value stocks will outperform growth stocks, i.e. mega cap 8 later this year? What are your thoughts about that?
This is Mark. I think anything's possible, right? Wouldn't want to rule it out. As Tim mentioned in a good part of his slides, the mega cap 8 overall as a group, I think, are overvalued. I think as the economy does not go into recession, so these companies, part of the reason they're overvalued is they're growth companies that became safety trades as well. So when people were scared about banks and the economy, they ran into these companies that they thought would grow in any environment. Well, as the economy broadens out and grows, I think you're going to see a widening out of the base in the market, and so that value could outperform those stocks in the next 6 months. I think the easier prediction is that the value will outperform those sorts of stocks over the next 3 to 5 years, because the valuations are very high, and over very, very short periods of time, which would be the rest of this year, valuations don't really correlate to forward returns at all that high of a level. But over a 5-year period, valuations correlate very strongly with forward returns. So meaning, in the short term, who knows with valuation, but over longer periods of time, valuation disciplines do tend to work. So.
Yes, we're as Tim, we're not allowed to say history repeats itself, but luckily we're allowed to think it. In history of these cycles between growth and value, or that a 10-year growth cycle quite extended, and we had a 10-year growth cycle going into the pandemic, and it was extended as people moved to their basements and bought more technology software and computers and did remote computing. That period is over. If a 10-year cycle is extended, 12 years is certainly far extended. History suggests that the subsequent 10 years will reward value investors. And so one of our many disciplines is that we pay attention to valuations. We want to benefit from valuation multiple expansion. And the way you do that is by buying undervalued companies. We think that, along with other disciplines that we're following, will help us a great deal over the next 1, 3, 5, 10 years. So we're very, very excited about not only how we're positioned, but how the long-term cycles should appear over the next several years if history repeats itself.
Thanks. Well, that seems to be the last of our questions. A couple things before we wrap up here. We have both clients and also folks that might be interested in working with us here at Capital Management Corporation. We want to thank our clients for being great clients, as they always have been, and also several of the folks on the call, on the webinar, who have who have referred us to their friends and family. We greatly appreciate it, and we welcome more. And then lastly, as a reminder, again, we recorded today's session. We will post it up on the website likely tomorrow or Monday, and you will receive an email when it's up there. Thank you again, and have a great rest of the day as well as upcoming weekend. Bye.